Hello, this is Brian Fries with Ag Perspective, and I will be giving the crop insurance portion of our 2016 winter meeting. Bryce Olson will give the Farm Bill update in a separate video. So the topics that I'll be covering are, first and foremost, whole farm revenue protection, called WFRP. I'll be going over some new rules, updates, insurance carrier billing issues with the company we had last year. We'll be talking about private insurance products, and then I'll finish off by talking about budget negotiations, some governmental developments, and how they might impact crop insurance. So first off, whole farm revenue protection, called WFRP. Now this type of policy provides revenue coverage for all commodities on the farm under one policy. The revenue guarantee is determined by submitting 5 years from your Schedule F tax forms. And the years that we would be looking at are 2010 through 2014. 2015 is not used because your records would not be ready in time. So, traditional crop insurance uses a yield history, a historical yield history to set a guarantee. WFRP is a little different because it uses a historical revenue, emphasis on revenue and not income. So it looks at your historical revenue as reported on your Schedule F. Should also note that if you are a corporation, you may not file a Schedule F, and if that is the case, you can turn in your corporate return, and then your agent would convert that to a Schedule F format. Now this product replaces AGR Lite. Some of you purchased this policy back in 2014. Now when they made the change from AGR Lite to WFRP, they made that change last year for the 2015 crop year. They made a very significant change that I'll explain here in a little bit, and for that reason we were not nearly as excited about this product in 2015 or even here in 2016. Coverage levels go from 50 to 85%. If you have less than 3 commodities, the highest coverage level you can carry is 75%. Specialty and organic commodities can be covered. It is for commodities such as these that this policy was originally created. The claims process can be and is arduous. This policy is not simple, and to give you an example, we finished off our last 2014 AGR Lite claim about 2 months ago. I will say that the farmer was received an indemnity in line with what we thought it should be, but I think one just has to go into this policy recognizing that it is somewhat complicated. So we do not see WFRP as a replacement for traditional crop insurance, but the question is, could it be a complement to the crop insurance that you're already buying? So to answer that question, let's take a look at how it works in more detail. So it sets a revenue guarantee, and the revenue guarantee is the lower of the 5-year adjusted gross revenue average or your 2016 expected revenue. So when one first looks at this policy, they think, oh, that sounds really good. I've had a historically high revenue years. I'm going to use those to set my guarantee, and that should set a very high guarantee. Yes, but, and this is a big but. The but is that if your 2016 expected revenue is lower than your 5-year average, which it will be for most people, then you have to use your 2016 expected revenue. So we would anticipate that for anybody looking at this policy for the 2016 crop year, their 2016 expected revenue will be lower than their 5-year adjusted gross revenue, so it'll be their 2016 expected revenue, which will be the determiner for their guarantee. So how is that set? The expected revenue, when you're looking at grains, would be the farm's average yield. That would either be their last 3-year average yield or their 10-year trend adjusted yield, whichever is higher, times the spring price, times the number of acres. Now this is where WFRP made a really big change from AGR Lite. With AGR Lite, right here, they let us use a price that was a 5-year average price. They did not make us use the spring crop insurance price. And in 2014, we were able to use a price that was considerably larger than the 2014 spring crop insurance price. That allowed us to lock in a guarantee for farmers that were carrying an 85% RP policy. That this component allowed us to lock in a guarantee that was even above that. Even though they could only carry a 75% WFRP, because we were using so much higher of a price, we were able to lock in a guarantee above their WFRP. So most farmers will only qualify for 2 commodities making 75% the highest level. And most producers will set a higher revenue guarantee with their RP or ARP insurance making the WFRP of little value. You cannot double dip on this. Your RP or your ARP claims would be counted as revenue in the WFRP equation. So if your RP guarantees are well above your WFRP guarantees, it makes the WFRP of much less value. Now, WFRP is very inexpensive. Quotes for 75% policy in most of the state of Illinois or in the Midwest in Indiana or Wisconsin are going to be, actually Wisconsin's quite a bit higher, so we'll say Illinois and Indiana, $5 an acre or less for a 75% policy. But one has to really analyze it and make sure that they're actually buying something for that $5. So where can WFRP fit? We do not see this as a policy for everyone, for the masses, but we do think that there is some places where it could be a fit, and one of them would be with a grower that has specialty crops, one of them being seed corn. Seed corn is a product, or is a crop that there is no revenue policy for it. So WFRP could potentially work for a seed corn producer, or obviously somebody that's growing vegetables or organic crops that are hard to insure. Another fit would be for farmers who can qualify for 3 or more commodities. Also a fit would be livestock farmers. That might not be as good as it looks, but for livestock farmers you can get coverage with this. Livestock can be one of the commodities. When I say that might not be as good as it looks, remember that again you're only protecting expected revenue. So if you're spending $1,200 for feeder calves and you're only going to be selling them for $1,500 or $1,600, all you're really going to be able to insure is that spread, because that spread's going to be a lot lower than your 5-year expected revenue. Again, it kind of is a little misleading when you think about it, because you think, oh, we had great livestock revenue years, now prices are challenged, and that's still going to be overridden by your 2016 expected revenue. Another fit for WFRP could be high-risk land, someone that farms a high percentage of high-risk land, because the high-risk land rates for RP are very high. They're escalated, whereas for WFRP, they are not. And I think the last fit that I'll talk about here is for a client that insures with ARP, which protects them at the county level. It's not using their own yields, it's using the county yields. Someone insuring with ARP always runs the risk is, what if I'm the only one that has a problem? What if my yield gets significantly hit but the county's doesn't? WFRP could come in and provide some coverage for that person to cover that what if scenario. So to obtain a quote, we're happy to run a quote for anybody. We're well trained on how to do this. All we need is your 2010 through 2014 Schedule F or equivalent for corporations and your 2016 acreage intentions. Alright, leaving that, let's look at some new rules. ARP, a new rule that's significant is that clients who use ARP now have to report their yields. And if you don't report their yields, the highest ARP policy that you can purchase is a 70% coverage level. You can report one yield for the entire county or by individual farm. And the deadline for doing this is February 15th. If you have any questions on that, please contact our office. Another feature that's actually not new this year, this was in place last year, but just something I wanted to bring up, is that for those that have irrigated production, you can now use separate enterprise units by practice. What this effectively means is that your irrigated farms would be one unit for loss determination, and your non-irrigated farms would be another unit for loss determination. You can also carry RP at different coverage levels on each one of those practices. So that's very significant because in the past, the irrigated production and the non-irrigated production was all lumped together for loss determination. So I think one can see how this is a big benefit for an irrigated producer. Added land, a change that just came out. So added land is assigned a yield based on the simple average of all other units. So when you go pick up a new farm, historically what we've done is just average the units from all of the other farms. And historically we've been able to average the trend adjusted yields. However, they've made a change to this starting in 2016. The simple average for this added land will be of the non-trend adjusted yields. Again, this is a rule that just came out. We're unsure why they came out with this, but we did want to make everyone aware of it because this could be significant on added land. We all know the benefit of trend adjustment. Now what this is effectively saying is that on your added land, the trend adjustment will not be a benefit in year one. Then moving forward, the new yields will get trend adjusted, but the historical yields will not. One other note on conservation compliance. Part of the 2014 Farm Bill said that all the crop insurance, in order to get or receive the crop insurance subsidy, your farms had to be in line with conservation compliance, and a Form 1026 at the FSA office had to be in place. And even one farm out of compliance would eliminate the crop insurance subsidy on all farms. So you can still buy crop insurance, you just won't receive the subsidy, which is about half of the premium in most cases. So something you definitely want to make sure that is in place on all your farms. And if you're buying a new farm or renting a new farm, you really want to make sure that it is in compliance as well. Last year we had some issues with Heartland Insurance Company and some billing snafus that they had. They were partially billing MPCI premiums. They did a separate billing of their private replant policy, and we have their assurances that these issues are fixed and will be fixed for next year, and we just really want to apologize for the headache that was created. I've had numerous conversations with the president of their company, and he has assured me that these are fixed going forward. And one of the big reasons, kind of moving into the private product discussion, one of the big reasons that we work with Heartland is because they offer what we view as the most superior wind insurance policy available. And wind in northern Illinois particularly is a really big deal and something that we pay really close attention to. Historically, ADM's been kind of our anchor for wind policies, but Heartland came out with their policy last year that is considerably better. So let's just kind of walk through it. In the area of green snap deductible, that's the first place we'll look at. That's for when the plants snap off. Heartland has a disappearing 5% deductible. ADM has a excess 5% deductible. That is significant because on that deductible, as the loss gets higher, the deductible for Heartland disappears. So at 25% green snap, the Heartland deductible is gone, and the ADM deductible never does disappear. So if you have a greater than 25% loss, that's like getting paid an extra 5% with Heartland. And if a person has $800 of coverage, that's $40 an acre advantage. So that's one area they're superior. The only place where ADM has a slight edge is in the starting point. They both go to November 1st now. That's something new for ADM this year. But ADM starts at emergence. Heartland starts at 7-leaf. Heartland is going to look at changing that for 2017. But for us, historically, we haven't seen that as being an issue. And I believe that Heartland will be very lenient on the enforcing of that as well, should there be a problem. But their policy does say 7-leaf. Pollination coverage. This is really significant. Heartland has that and ADM does not. Pollination coverage would protect during that 10 or so day window when the corn is pollinating. And many of you have run into this before where there was a wind event during that time period and the pollination was affected and you had half of the ear that's maybe missing kernels, some sort of a bottleneck or zipper ear or something along those lines. And Heartland will essentially make a stand count of the plants that have a deformed ear due to that wind problem at pollination. Again, this is only a wind pollination problem, not a heat pollination problem. But they will make an assessment as to what percentage of plants were impacted, and they will pay up to 20% of the liability for plants that maybe are standing straight up now, but they have some sort of a deformity to the ear caused by the wind. So again, that's pretty significant. Extra harvest expense, they're both the same at 8%. Heartland offers a cash discount, ADM doesn't. Heartland's replant can be purchased as part of the wind policy, or it can be taken out if somebody's not interested in purchasing that part. And it's $60 per acre. ADM's is $50 per acre, and it's bundled into the policy. And so the cost per $100 of coverage then for Heartland is less expensive than ADM, and we see it as being a superior policy. So we really like ADM. We like a lot of things ADM does. It just so happens that we feel that Heartland has a superior policy. All right, Ag Armor, a product that they have called Harvest Max. Now this is not a hail or a wind product. This is a yield protection product, protecting your yield from a loss due to a multitude of things. Anything that your RP insurance would be covering. Ag Armor is a private crop insurance company. They are not an AIP. That means that they do not offer the federally subsidized products. All that they offer in the marketplace is their own private products that they have created. And this one policy that they have called Harvest Max with a max revenue endorsement is something that we're interested in. It is designed to complement RP and protect in a shallow yield loss scenario. It allows a producer to insure up to 95% of their approved yield with a 10 bushel minimum deductible corn and 3 bushel minimum deductible on soybeans. They offer an endorsement to Harvest Max called Max Revenue that adds some downward price protection. And what this means is that as prices decline, the trigger yield raises based on the percentage of the decline. So here's an example of an RP policy. So we're going to assume with this RP policy, we're going to be optimistic and assume a $4 spring price, which is the average of next month. We're going to look at 85% coverage level and someone with 190 bushel trend adjusted APH. And with that policy, if you keep price the same as $4 or higher, the trigger yield is 161.5. And one of the areas that's always a concern is a shallow yield loss, like let's say this area of 160 bushel yield, not a huge yield loss, but just below the trigger, and corn is, let's just say 450. That just isn't enough to help out. The price hasn't increased enough to make up for the bushels that you're short. So that shallow yield loss area is an area of concern. And that's where a product like Harvest Max would come in. And in this example, I'm going to look at a 91% Harvest Max policy. Why did I pick 91? We just really analyzed it and we tried to figure out where are you getting the best bang for your premium dollar, and 91% looked good. So at 91%, that raises your trigger yield from 172.9, it raises it from 161.5 to 172.9. And then this policy would be designed to cover the gap between 172.9 and 161.5, so roughly 12 bushels. And the Harvest Max price is $3.94, so what that basically means is you're going to get paid $3.94 for the short bushels. So on this policy, the maximum payout is $47. So if you go to that same area there where you look at 160 bushel yield at $4.50, now with the Harvest Max, in addition to the $6.75, you would also receive a $47.28 payout. And the premium for this policy we estimate to be around $13.85. So in a year where we don't have the prices that we want, it's really even doubly important that we have the yield protected. Because if we can't get to our revenue goal based on price, it's really important that we get there based on yield. So all Harvest Max does is for those that are so inclined is it comes in and it provides a little more yield coverage for those that are concerned about those shallow yield losses. Once again, as we've said before, there's gobs of private insurance products out there. We try to look at all of them. And in the past, we've been pretty big proponents of some of the pricing policies where we can try to use their private products to lock in higher prices for our crop insurance guarantee. And those are all still out there, being Price Flex and another one called HPA, all ones we've done in the past. When we meet with you all one-on-one, we'll still talk about those. But this year, this is something that's a little bit newer, and it's something that we think is worth taking a look at, primarily because, as I said, we're not going to have the crop insurance prices we want. It's doubly important that we get the yields and we have the yield protected. So a product like Harvest Max can do that. So my last topic then is to talk just real briefly about the budget negotiations in crop insurance. And just a reminder, the Farm Bill itself actually added a fair amount of spending to crop insurance, making it a $9 billion per year program. And now crop insurance is the second largest component next to nutrition. Of course, nutrition dwarfs everything else. It's about 80% of the Farm Bill. But nonetheless, crop insurance now is the number 2 portion of the Farm Bill next to it. Now, some of you may remembered or followed along some of the political theater that went on in late 2015 around a budget agreement that was put together. And in that budget agreement, as it pertained to crop insurance, it called for a $3 billion cut. Now, this was eventually reversed, but what I thought was interesting was at the time that this cut came out, another group of lawmakers came out with something called the Affirm Act. The Affirm Act stands for Assisting Family Farmers Through Insurance Reform, and a couple gentlemen from Wisconsin brought it forward. Now, this Affirm Act has gone nowhere in Congress, and at this point I don't think it's going to go anywhere. However, it does point to some things that I think are going to give us an idea of the type of objections to come at crop insurance to come. And what they're calling for is the elimination of the harvest revenue option, a $40,000 max on the premium subsidy, a decrease in the amount of subsidy by 10%, and no subsidy if income is over $250,000. So essentially applying a means test to the crop insurance subsidy portion of the Farm Bill. So like I said, I think this just gives us an idea of the type of objections to come. Before long we'll be talking about the next Farm Bill, and there's also some pretty significant negotiations that go on every 5 years, which 2017 I believe is the next year for that, called the SRA, Standard Reinsurance Agreement, between the private crop insurance sector and the federal government. So I'm sure all these issues will come to light again then. So that concludes my portion of the crop insurance update. I encourage you to listen in to Bryce Olson on the government programs discussion, and so you can see how ARC County and PLC finished off for 2014, and what we're projecting for the 2015 crop year. So thank you so much.